Welcome to Money Maverick, your ultimate destination for all things trading. If you're passionate about the financial markets, seeking valuable insights, and eager to be part of a thriving trading community, you're in the right place. Managing risk is a crucial aspect of future trading. By effectively managing risk, traders can protect their capital, reduce potential losses, and increase their chances of long-term success. Here's a detailed description of how to manage risk in future trading. 1. Understand risk and reward. Before diving into future trading, it's essential to have a clear understanding of the relationship between risk and reward. Recognize that higher potential returns often come with higher levels of risk. Determine your risk tolerance and establish realistic expectations for your trading outcomes. 2. Set stop-loss orders. A stop-loss order is a predetermined price level at which you exit a trade to limit potential losses. Determine an appropriate stop-loss level based on your risk tolerance and the market conditions. Placing stop-loss orders helps protect your capital by automatically closing the trade if it moves against you. 3. Use position sizing. Position sizing refers to determining the appropriate amount of capital to allocate to each trade based on your risk tolerance. By implementing position sizing techniques, such as the percentage risk method or the fixed dollar risk method, you can ensure that you don't risk too much of your capital on any single trade. 4. Diversify your portfolio. Diversification involves spreading your trading positions across different markets, instruments, or sectors. This helps reduce the concentration of risk and potential losses. Avoid putting all your capital into a single trade or a limited number of highly correlated trades. Diversification allows you to benefit from a variety of market opportunities. 5. Conduct thorough analysis. Before entering a trade, perform comprehensive fundamental and technical analysis. Understand the market dynamics, consider the potential risks and rewards, and identify key support and resistance levels. Analyze factors such as market trends, economic indicators, and relevant news that can impact the price movement of the future contract you're trading. 6. Keep up with market news. Stay informed about the latest market news and events that can influence the future contract you're trading. Monitor economic releases, company announcements, geopolitical developments, and regulatory changes. Being aware of potential catalysts and their impact on the market helps you make more informed trading decisions. 7. Utilize risk management tools. Take advantage of risk management tools offered by your trading platform. These tools may include order types like limit orders, trailing stop orders, or guaranteed stop orders. Familiarize yourself with these features and leverage them to manage your risk effectively. 8. Maintain emotional discipline. Emotional discipline is crucial for managing risk in future trading. Avoid making impulsive decisions based on fear or greed. Stick to your trading plan, strategy, and risk management rules, regardless of short-term market fluctuations. Emotions can cloud judgment and lead to poor decision-making, so maintaining discipline is key. 9. Regularly review and assess. Continuously monitor and assess your trading performance and risk management strategies. Regularly review your trades, analyze the outcomes, and identify areas for improvement. Keep a trading journal to track your trades, emotions, and lessons learned. Adjust your risk management approach as needed based on your trading experience and evolving market conditions. 10. Educate yourself. Never stop learning. Stay updated with market trends, risk management techniques, and trading strategies. Attend seminars, webinars, read books, follow reputable trading sources, and learn from experienced traders. Enhancing your knowledge and skills helps you make more informed decisions and adapt to changing market conditions. Remember, managing risk in future trading is a continuous process. It requires discipline, ongoing learning, and a willingness to adapt. By implementing these risk management practices, you can better protect your capital and improve your overall trading performance.